In late 19th century Paris, the official stock exchange believed it had solved speculation. The Paris Bourse was orderly, heavily regulated, conservative by design. Only approved brokers could trade, only approved securities could be listed, only approved behavior was tolerated. The problem was simple. Investors did not stop speculating. They just walked outside. Just steps away from the grand halls of the Paris Bourse, an unofficial market emerged. No licenses, no formal listings, no oversight. Traders gathered on sidewalks and arcades, shouting prices, passing paper contracts hand to hand. This informal marketplace became known as the Coulisse, France's curb market. At first, it was dismissed. Serious money belonged inside the Bourse. The Coulisse was for new companies, risky ventures, securities the official exchange refused to touch. But that was precisely its appeal. The late 1800s were an age of transformation. Railways expanded across Europe, electricity emerged, canals, mining companies, overseas ventures, all needed capital. The Paris Bourse moved slowly. The Coulisse moved fast. If a company was too new, too foreign, or too speculative for the official exchange, it found a home on the street, and investors followed. The curb market created a powerful illusion. Because it existed outside regulation, many investors assumed that prices reflected superior information. Returns compensated for risk, and information meant opportunity. In reality, it meant something else. Loose rules, thin liquidity, easy manipulation. Speculation flourished not because risk was understood, but because it was underestimated. Here is how the bubble formed. New securities listed on the Coulisse. Prices rose rapidly due to speculation. Rising prices attracted more traders. Liquidity appeared stronger than it was. Confidence increased. The absence of regulation was reframed as innovation. What was actually fragility was mistaken for freedom. French regulators believed something critical, that keeping speculation outside the official exchange made the system safer. In theory, the Bourse remained stable. Speculation was isolated. Damage would be contained. In practice, capital flowed freely between markets. Banks financed curb traders. Losses spread invisibly. The curb market was not separate. It was interconnected. When confidence faltered, as it always does, liquidity vanished. Prices collapsed rapidly. Buyers disappeared. Contracts became worthless overnight. Many curb securities were impossible to sell at any price. Banks that had quietly financed speculation suffered losses. Investors learned that unofficial also meant unprotected. The damage did not stay on the sidewalk. It traveled back into the financial system. The collapse was not caused by speculation alone. Speculation has always existed. The real failure was believing that regulation eliminates risk rather than redistributes it. When official markets become too restrictive, risk does not disappear. It migrates to darker corners, to thinner markets, to places where failure is faster and more violent. This pattern repeats throughout financial history. When one part of the system becomes too controlled, another part absorbs the excess risk. Shadow banking, off-exchange trading, unregulated financial products. Different names, same behavior. The Paris curb market was not an anomaly. It was an early warning. Markets do not choose safety or danger. They choose paths of least resistance. Capital flows where rules are light, returns look high, and scrutiny is low. Until it doesn't. The Paris Bourse believed it had protected investors by keeping speculation out. Instead, it pushed speculation somewhere it could not see and could not control. Financial history teaches this quietly but consistently. You cannot regulate risk away. You can only decide where it shows up and who pays when it does.